Hey guys, welcome back, and today we're going to talk about this article. Nio Not Tesla is the better EV stock pick for 2021, and I disagree, but I do think this is a conversation worth having, and it's not a crazy thought to compare these two. It's very fast growing, headquartered in Shanghai. It's got really good fundamentals, it's got cool cars. It's definitely in competition with Tesla, but there are many points here that I believe need more clarification. Let's dive in. First, this is an article by a blogger called Jeff Reeves, and let's look at their analyst rankings. 4 stars out of 5. Not bad. Again, I always take a look at this because if you're a basketball coach, you don't have to have had the best stats as a player, but as a financial blogger or analyst, your stats, your returns is a pretty close to one-to-one correlation with whether or not we should listen to you. I give him some credit. His ranking is pretty good. And as always, I am not a financial professional. I'm just a guy who loves technology and finding the best investment opportunities. These are just my thoughts at the moment, and they will change as I learn new information. Now let's dive deeper into the article. Nio is the better way to profit from China's growing market for electric cars. 2 of the most popular stocks on the planet right now are electric vehicle manufacturers Nio and Tesla. Together, they trade about 200 million shares daily, thanks in large part to young individual investors hungry for a piece of the action. But these stocks are decidedly not the same. Tesla, which went public at a mere $17 a share more than 10 years ago, has been through the Wall Street ringer, while Nio made its debut in US markets a little more than 2 years ago. Tesla is US based with a cult-like following in American car culture and a quirky CEO, while Nio is a Shanghai-based EV company that doesn't have the same amount of fireworks around its brand. One thing that I do take issue of is this constant referral to Tesla's following as cult-like. I would argue that any brand that has a devoted following isn't necessarily cult-like. It becomes cult-like when it's no longer based in reality. But Tesla, as of right now, is the #1 EV company in the world, and for good reason. They are building the best EV cars at the cheapest rates. I don't think anyone is arguing that they aren't #1. The competition is very, very far behind it. To call it a cult-like following diminishes their place in the world right now. Both picks have a lot of long-term potential as they are core players in the long-term growth of the electric vehicle market, but if I had to pick just one to purchase at this price and hold for all of 2021, my money is on Nio over Tesla. Here's why. Nio's secondary offering was well-timed and appropriate. Some investors panned Nio's recent secondary offering in December as a blatant money grab to capitalize on its skyrocketing share. So what? Public markets fundamentally exist so companies can raise capital to keep growing, and the $2.6 billion windfall for Nio was the right move at the right time. Nobody held a gun to anyone's head and demanded they pay $39 a share. That was a fair price, and in truth, more than 7% below market rate at the time. I don't really have any issue of Nio's secondary offering, and I didn't get the sense that a lot of people were hating on it. He follows up with, if you hate secondary offerings, you hate Tesla too. This point isn't really the strongest point. I think it's fine if companies want to raise money. The downside of them raising more money like this, having multiple offerings, is it dilutes the shares, so I understand why some people would get upset. But this isn't really a pro-Nio or anti-Tesla anything. He's arguing that the timing was a little bit more appropriate. From my perspective, if you are an EV company, you are a growth company because there's so much stuff that you still need to invest in and build. So any company that needs to raise more money, generally, I'm fine with it. Here we have a graph of the growth, and this isn't an absolute share price, but it's just the percentage of how much they've grown. Had you bought in earlier this year when its share price was sub $3, your return on capital would have been astronomical. Tesla is not shorthand for EVs. As an analyst at Roth Capital Partners said in November, Tesla is an umbrella stock that is tied to all other names in the sector. So he's saying that Tesla seems to represent all of the other EV companies, and people forget that there are other competitors. But people forget that there are other competitors because the other competitors as of right now are just not competitive. Even here, Jeff says, I don't dispute that, but I don't see it as a good thing. While it certainly has a more direct link to electric vehicle adoption than a legacy automaker like Ford Motor does, that is an understatement. That is still lagging way behind the pack. It is dangerous to think that more EV sales definitively means an ever increasing market value for Tesla. Definitively is a very strong word. That means 100% confidence. But I could probably say 99.9% confidence that market value for Tesla will continue increasing, save for some astronomically catastrophic occurrence. Just as the tech bubble separated the powerhouses like Google from pretenders like the Globe, eventually markets will stop buying the trend and start looking at individual stocks. That could be dangerous for Tesla given its sky-high valuation. I don't think Tesla has really dug in to the fact that the trend is EV. They say that because they are actually the ones bringing everybody into the future. They are not following the trend. They are the trend makers. I agree that Tesla's valuation is pretty high right now. Long term, I don't think it's too high. I think if you look at all of their investment in the growth phase that's happening right now is going to pay off relatively soon. And mainly that will come in the forms of their new battery technology, which are giving us better batteries for a fraction of the price, in addition to their full self-driving beta that has recently rolled out. And there are actually cars that can navigate regular suburban roads. And that's all coming soon, and the moment those come to fruition, this stock is going to skyrocket. Here things get a little bit more interesting when we talk about Tesla. Tesla has a long way to go in China. Though much fanfare has been made about China-made Model 3 vehicles, Tesla only sold about 21,600 of the cars in November. That was good enough to be number 3 in market share, but certainly not the game changer, and less than 1/3 of the monthly run rate necessary for forecasts of 880,000 China-made EV cars by the end of next year. Okay, so let's take a look at these stats. I found this graph from October, which is just about a month ago, and we could see that the Wuling Hongkong Mini EV was number 1 with 20,000 vehicles. Now, Tesla Model 3 is actually number 2 in this graph at 12,000. Of course, the author said that it was number 3, and here you can see if you add all of the cars made by BYD, right here, BYD, that definitely surpasses the number of Tesla Model 3s. But if you were to look at this graph, Tesla Model 3 as the one individual car is actually quite popular. Now let's go back a little bit into the past, and we'll see from January to October 2020, Tesla Model 3 was actually the one car that was number 1. And again, if you add up the BYD cars, BYD ultimately surpasses Tesla. But Tesla was at the top. Wuling is a new mini EV that's gained a lot of popularity. This adorable 4-seater electric hatchback is selling like crazy in China. This is the Wuling. It's a micro electric car. It's really, really cute. And the important thing is that its starting price is $4,162, and a fully loaded car is $5,607. So the car right now that's selling the best, I don't think it's quite comparable to a Tesla Model 3 that's selling close to $40,000. They aren't really fighting for the same market, in my opinion. So that's something that you should take note when we look at the China sales. Where's Tesla's China explosion? Total electric vehicle sales in China are living up to expectations, with November's tally surging more than 130% to 169,000 units. While Tesla dominates the US market, its 21,600 units sold in China is a very tiny sliver in a crowded field. What's more, the raw China growth rate for Tesla may be impressive at 45% more vehicles sold. Thank you for admitting that, compared with 15,000 vehicles sold in June. But it's really hard to get excited about a measly 6,000 more vehicles produced after 6 months when the stock is valued at more than 600 billion. So a little bit of conflation. He's saying that, okay, so you improved a lot. 45% more vehicles sold is a tremendous amount, okay? But yes, if we compare it to the stock, which is overvalued, maybe it doesn't seem as impressive, but don't downplay this 45% vehicle growth. And right now, Tesla has a Shanghai Gigafactory that up till now has been doing finishing touches on their cars. They are in the process of really ramping up production and making it truly what they call made in China. Instead of getting a lot of parts shipped in and then put together in the China factory, they ultimately want more stuff to be built and put together within China, so it's actually vertically integrated. NIO's growth is for real from a smaller base. Demand is very, very high in China, and once Tesla's Gigafactory is able to pump out more cars, I think their sales will continue to increase. NIO's growth is for real from a smaller base. So far in 2020, NIO has admittedly only delivered 36,700 total vehicles, but that's more than 110% more than 2019's tally, and it's aggressively investing to keep production ramping higher. That's great. NIO is a great company. I think it has a lot of growth ahead of it. There's enough pie to go around, but if I had to choose one, I would still choose Tesla. While Tesla's China growth has to be digested as part of an established multinational company operating in the US and Europe, NIO can capitalize on the China opportunity directly. If you recall the early days of Tesla, the EV manufacturer sold people on the promise that 30,000 deliveries could become 300,000 in just a few years, and NIO appears to be tracking that growth plan too. NIO has ties to state-owned allies. Recently, NIO signed a deal with State Grid Electric Vehicle Service Co., a part of China's massive state-owned utility. The plans are modest to jointly build only about 100 charging and EV service stations in 2021, but show that NIO is doing what all successful Chinese stocks must do, which is to win favor with state-owned allies to continue growing its business and squeezing out competitors. This is definitely one advantage that NIO has. China has experienced the growth it has by essentially shutting down a lot of foreign companies and only supporting their own internal companies, see Tencent or Alibaba or Youku. Google, YouTube, Amazon dominates the international market. The way China has done things has worked to build their own companies. On the flip side, just on December 2nd, the House of Representatives passed the Holding Foreign Companies Accountable Act, which is a law that requires additional disclosures from Chinese companies with the intent of ensuring that they are complying with U.S. accounting rules and overseeing their operations. If they are not in compliance, ultimately they could get delisted. Now, the chances of this are very, very low. I fully expect that they will pass compliance, but this is just to note that there are risks in investing in Chinese companies. We don't have the same level of oversight, and there have been horror stories in the past of Chinese companies essentially just disappearing off the face of this earth. Meanwhile, Tesla's factory is 100% American owned, and while Chinese banks provided $1.4 billion loan for the facility, that's far different than a business partnership with partners in Beijing. NIO doesn't have Tesla's hype machine. There's no middle ground on Tesla. Right now, Goldman Sachs has a price target of $780 on the stock, while JP Morgan Chase's is $90. Hedge fund icon Jim Chanos put it aptly on Bloomberg TV recently, saying Tesla is worth whatever people want to believe Elon Musk is touting. Yeah, I don't think there's middle ground because one person is wrong and one person is right. This $90 price target from JP Morgan I brought up in another video, these people just only see Tesla as an auto manufacturer, and that's just wrong. They're not an auto manufacturer. We just think they are because the stuff they're producing look like cars. The closest thing we can come up with is that these are cars, but these are not cars. Saying Tesla cars are just cars when they're actually supercomputers, when they're collecting data, when they could constantly be updated, when they are getting better over time, something that no other car before Tesla could really do. If you were to buy a Toyota Camry, one of the best, most dependable cars, sure, it could last 10, 15, maybe even 20 years, but would you say that it got better every year? With Tesla, you could have bought a Tesla Model 3 in 2017, and then come this year or next year, all of a sudden it's driving by itself. The key point is that these cars are improving. And I keep saying cars, but these are robots. These are metal shells that contain software that's ever evolving. Just like the original iPhone was not just another phone, and people completely missed it. The original iPhone was a computer in your hands. But if we called it that right away, people would probably get confused. So for most people, yes, Tesla is a car company, but for people that really understand what they're doing, they are not just a car company. They should be valued like a technology company. If you enjoy this kind of meta investing, trying to think about what other people are thinking about, what Musk is thinking about, then focus on Tesla. You don't have to do that much thinking. You could see YouTube videos of a Tesla Model 3 driving itself. It doesn't require any huge leaps of faith. The technology is there. Just get inside a Tesla. But for many investors looking to cut through the noise and simply play the growth potential of China EVs, NIO is an option that sidesteps some, though admittedly not all, of the hysteria you'll frequently find around Tesla these days. I do not disagree. NIO is a great option, and I would say a supplement to any balanced portfolio if you want to be invested in EV. And sure, there is a lot of hysteria around Tesla. You can tell by the stock price. Even me personally, as a heavy Tesla investor, it's due for a correction, but that's just personally my opinion. It's fine. It's not like I'm going to sell anytime soon. But come 2021, with everything that Tesla is just on the forefront of revealing to us, I still would choose Tesla over NIO. Tesla is still in its infancy or maybe preteens. There's so much room for it to grow and to show us what it's really, really capable of. You just have to look at what they plan on doing and decide how long do you think that will happen. And once that happens, what is the value you put on that? What is the value you put on being able to pick up your grandparents from the airport and then it safely bringing them back, because this car is the safest car that's ever been in existence? What is the value you place on having insurance at a fraction of the rate it's been? That's all I have. Please like and subscribe if this was helpful. This is Green Knight Trading, where Squires become knights. I appreciate you, and I'll see you soon.